Hello everyone. Right now we're trying to survive in the stock market while so many events are happening at the same time. World politics, inflation, geopolitical risk, AI growth, inflation, and Fed. After the war began, almost $5 trillion disappeared from the stock market in just 2 months. And then almost $10 trillion came back to the market. In market like this wild, one question naturally comes up. Where are we in this cycle? When will this bubble end? Is the market still climb toward the top, or have we already passed the top? To think about this question, today I want to look at the market through the eyes of two legendary investors, Stanley Druckenmiller and Paul Tudor Jones. And near the end, also compare today's market with the 1968 and think about where we may be in this cycle. Before we start, I post the global market news every day on my YouTube shorts. I strongly believe this will help your investment decisions, so please check that out and subscribe to the channel so you don't miss any of them. Okay, then let's get started. When we look at the stock market, it is very easy to get lost because there is just too much information. World politics, inflation, interest rate, the economy, company earnings, and market cash flow. There are too many moving parts. Sometimes it can be helpful to listen to investors who have lived through many market tops and bottoms over several decades. The first person is Stanley Druckenmiller, one of the greatest macro investors of all time. Earlier this year, Druckenmiller said one of the risks he fears the most is a story-driven bubble. He also compared the current market to a baseball game and said we may be in the seventh or eighth inning. This is an important point. The eighth inning means the game is getting close to the end, but at the same time, it also means the game is not over yet. There may still be two innings left. There could even be extra innings. So the message is we should know that the end may be getting closer, but we cannot say the game is already over. That is the careful balance in Druckenmiller's view. The end may be closer, but it is not here yet. He also added one more important point. Before serious economic crisis, like the Great Depression or the financial crisis, there was usually an asset bubble first. This can be read in two ways. First, it is clearly warning. If a bubble is forming now, then a serious problem could come after it. But second, it can also mean that there may still be time left because bubbles usually keep growing before they finally burst. The second legendary investor is Paul Tudor Jones. Many people call him PTJ. He is famous for predicting Black Monday in 1987. That is why his recent comment is very interesting. He said he bought more AI stocks. This matters because a person who once saw a major market crash coming is now buying more AI names. PTJ compares today's AI cycle with a productivity boom that came from the PC and the internet. And he sees more room for the market to rise from two different angles. The first angle is productivity. If the AI productivity boom is still in the early or middle stage, then the market may still have about 2 more years to run. He also said there could be around 40% more upside. In other words, if AI is not just a theme but a real productivity boom, the market could go higher than many people expect. The second angle is price level. PTJ said today's market feels similar to the fourth quarter of 1999. That was the final big move before the dot-com bubble reached its top. So the meaning is this: we may not be at the top yet, we may be getting closer to it. This sounds very similar to the Druckenmiller's seventh or eighth inning idea. So whether we look at productivity or price level, PTJ still thinks there may be more upside left. But PTJ does not ignore the risk. He also said that one day we could see a very sharp correction. So yes, the market can still go higher, but when the turn comes, the drop could be very painful. If we put these two views together, the message is quite similar. Both investors do not think this cycle is already over, but both are also watching the end of the bubble very careful. So what could the end look like? There are three signals to watch. The first signal is more stock supply. This includes IPOs and new share offerings. In 2026, we keep hearing about big IPOs. SpaceX, OpenAI, and Anthropic are some of the biggest examples. If these huge IPOs come to the market, the total supply of stocks will increase. they could also pull a lot of cash away from the rest of the market. This often happens near the late stage of bubble. When stock prices are high, companies try to raise money. Even if demand for new shares is strong, prices can still feel pressure if supply becomes too large. This is where Ken Fisher's idea about stock supply and demand is useful. He often talks about the dot-com bubble. In 1999, tech IPOs became very hot. Tech companies took a much larger shares of the whole IPO market. The total supply of stocks in the US market also increased. Then around March 2000, the bubble slowly started to break. Of course, more IPOs do not always mean bad news for the market. If investors are excited, if there is enough cash, and if the economy is strong, the market can absorb the new supply. Also, when IPO hopes grow, other stocks in the same sector can benefit too. So we should not only count the number of IPOs, we also need to look at IPO size compared with the GDP and the overall cash flow in the market. The second signal is a break in the AI story. Right now, AI is the biggest force holding up this market. If the AI story starts to crack, one of the most important pillars of the market could shake. This is especially important because PTJ's bullish view depends on the idea of an AI productivity boom. If that idea breaks, the market could change direction very fast. The third signal is a financial shock coming from crypto. Global payments and financial networks are becoming more connected through blockchain technology. There is also tokenization trend Larry Fink at BlackRock often talks about. This means more real-world assets are being turned into digital tokens and traded in new ways. This connection can be both good and dangerous. In normal times, money can move faster and the system may become more efficient. But when a shock happens, the shock can also spread much faster. If a crisis starts from some trigger, a crypto could become one path that spreads risk across the wider financial system very quickly. So the three big warning signs for the end of the cycle are these: more stock supply, a break in the AI story, and a financial shock from crypto. This does not mean these risks are happening right now, but these are signals we should keep watching if we want to understand the late stage of the cycle. Now we need to look at today's market from a very different angle. The angle is 1968. In the late 1960s, the United States was in the middle of Cold War with the Soviet Union. To stay ahead of the Soviet Union, America spent huge amounts of money on national projects. The Apollo project, Vietnam War, and higher defense spending were major examples. There was also President Johnson's Great Society program. This was a large social spending plan focused on expanding. So one side of the government was spending more on defense for the Cold War, while the other side was spending more on social programs. And on top of that, there was the Apollo project. Money was flowing into many parts of the economy at the same time. Then, in 1973, the oil shock became the spark. But this is the key point. Inflation did not suddenly appear only because of the oil shock. The fire had already been building through the late 1960s because of heavy government spending. Then the 1973 oil shock touched the fire and it turned into the much bigger problem. So what about today? When we compare now with 1968, we can feel strange sense of deja vu. First, President Trump is pushing tax cuts. That means the government is leaving more money in private hands. In that sense, it has some similarity with the loose spending environment of 1960s. Second, just like a Cold War between US and Soviet Union, today we have a new Cold War style conflict between the US and China. The two superpowers are competing over technology, supply chains, and military power. There is also war and spending more on weapons and defense. It may not be the same as the Vietnam War, but the Russia and Ukraine war, tension in the Middle East, and Europe's tension with NATO. There is also the risk of an energy shock. Just as the 1973 oil shock became the trigger for the inflation back then, today's market cannot fully ignore risk like a possible closure of the Strait of Hormuz, tax cuts, a new Cold War, more government spending, and energy risk. These are same types of forces that fed inflation in the late 1960s. And now, they are showing up again. This is where the story changes. Druckenmiller and PTJ both accept that AI productivity boom could push the market higher, but the 1968 frame points us in a different direction. If today is closer to 1968 than the dot-com bubble, then we may need to look beyond tech stocks. We may also need to look at commodities and real assets. On one side, we have the growth story, AI, tech stocks, and productivity. On the other side, we have the inflation story that 1968 points to. And at the center of that story are commodities and real assets. When we think about the 1970s, the best performing assets during the inflation wave were not normal stocks, they were commodities. So the key question is this: should we see today as just another version of dot-com bubble, or should we see it as the early stage of inflation cycle similar to 1968? Right now, the market is getting closer to the end, but the later stage does not mean the end comes right away. In fact, the final stage usually has a higher move. But when the end finally arrives, the correction can also be very sharp. So this time is the when we need to both optimism and caution. We should stay open to the chance that the AI productivity boom push the market higher. But at the same time, we need to watch late cycle warning signs, more IPOs, break in the AI stories, shock from crypto, and energy risk. At the end of the day, investor is not the person who finds the one perfect answer. An investor is someone who finds the better positions across many possible outcomes. That is for today. Thank you for watching for the end. See you in the next video.